and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, which is the best mutual fund scheme? Should you invest in mutual funds for dividends? What if your mutual fund underperforms? These and many more similar questions we keep getting here at Value Research. And these are the kind of questions that delay an investor's investment journey. So today on Investors Hangout, we decided to answer some of the most frequently asked queries about mutual funds. Stay tuned.
There is no best mutual fund. You can only know it with hindsight, which was the best fund of 2021 or which was the best fund ending 2021 December for the last 10 years. So that information is no good. That is not relevant. After you invest and after that, which fund has done well, it is very hard to predict. Why you should not be looking for best fund. First is to look for the most appropriate fund. If you get lucky with the best fund and if you get lucky with selection of a best fund after you invest, and if it happens to be the inappropriate fund, it will be extremely disappointing. For example, if you just choose an equity fund, but you wanted to invest for 1.5 years and you are faced with a situation of a big decline, and that fund is the best fund. It does well. It does much better than all others. Over the next 4 or 5 years, it does very well. But you have chosen the inappropriate fund and it will give you a nasty surprise. Let me give you an example. This is something which I experienced. This is something which happened with one of our colleagues in Value Research. In 2007, just before the big decline came or the global financial crisis, the market was on a tear. Market was going up and he had chosen a nasty fund, a very bad fund, which was doing exceptionally well. It happened to be the best performing fund of 2007. And he was a young employee aspiring to have his car. And he checked with me. That is in the month of October, we were doing our anniversary issue of Mutual Fund Insight. And I asked him that, how did you choose this fund and so he said that he was just looking at recent performance and he has been very lucky. That was a fund which we were criticizing in our anniversary issue. And I checked with him that, what is he aspiring for, what he wants to do with the money. He said that no clear plan, but he was planning to buy a car. And then he was getting greedy just because the investment was growing very rapidly. He just thought that why not wait? I told him that if you have achieved your goal, realize the money and go and buy your car. There can't be anything better than that. And in the month of November, he did that. After he, redeemed his investment, the investment went up by another 10-12%. And he was not very pleased with that particular situation, taking his money off that investment and the market going up, the investment going up by 10-12%. And he was pointing to that. But then the global financial crisis happened. Everything looked unreal. He had achieved his goal. And January 8, the market started tumbling. And it fell so freely, and in next to no time the market was down about 50%. Then he was actually having fun. So that is one way of looking at it. If you have a target, if you are a goal-oriented person, and if you are investing for a goal, realize it, and after that don't look at the market. There are investments which are not goal-oriented. You are just investing for the long term. You will keep it for 5-10 years. It's for your financial security. That is where you need to worry about, look for the fund which is likely to be reasonably good. Look for the variables where the probability of that fund not being bad is very high. And make your own checklist that what will change in the fund when you will change your mind and take your money off. Like a change of a fund manager, or the fund actually starts behaving in a manner, or value research analysts actually start putting that fund on an alert in our premium service. So, those kind of situations. But otherwise, look for a reasonable fund. Look for a good fund which has done well in a falling market as well as a rising market. And stay put. Don't try to look for, a brief period of underperformance and trying to get out of that fund, because we get a lot of those questions. A fund which has done very well for last 5, 7, 10 years, and it does very poorly for the last 6, 7, 8 months. And the best performing investment actually do poorly in a brief period of time, and it is very hard to guess. So this should be your guiding principle. Choose the appropriate fund and choose a fund which has all the variables, and the variables are a fund which has done reasonably okay in a falling market as well as a rising market. The same fund manager is still managing the fund. The fund is doing something which you can decode. It is not a mysterious thing, so that you can clearly differentiate between a performance. And this will be reasonably factored in the up market, down market performance cycle. And with that in mind, because many investors complain about the star rating, that it is not working. The star rating is one of the variables. Besides that, you have to look for appropriateness of a fund is more important than the star rating. Then I think a star rating is a very useful thing for you to drop the fund. I would say that a star rating is very useful not for choosing a fund, but you should use the star rating for eliminating the funds. 1-star, 2-star funds, I would drop that. So it reduces your universe. And from there on, I think you should look for a fund which has done consistently well. And that's about it. The dividend from a mutual fund is not material, is not important. But investors have this perception, that they have this understanding that a fund which is giving dividend is performing. But in case of mutual fund, why it is not important? A part of your money from an open-end mutual fund you can realize anytime. And a dividend from a mutual fund is like realizing a part of your money, but a time of the fund's choosing, not your. So in that sense, it's a completely irrelevant thing. If you invest in a fund and you invest 10 lakh rupees, and tomorrow it decides to give a dividend, and it decides to give a dividend which is something like 1,000 rupees or 5,000 rupees. So the next day what will happen is you will get the money in your bank which is 5,000 rupees, and the value of your capital will get reduced by 5,000 rupees. The sum total of the money that you get in your bank and the worth of the investment which remains, that will exactly total up as much. So dividend from a mutual fund doesn't make sense, because you can realize the part of your money any time of your choice. You invest 1 lakh of rupees and you decide to take 500 rupees every day, and you can do that. 500 rupees worth of your investment can be redeemed from your, so it is almost like a daily dividend from your investment. Of course, you will start taking that money and your money will get eroded, in a time, because if the money is not growing at that pace. But so dividend from a mutual fund doesn't make sense. What you should do is, you should try and think in terms of how much money you need from your investment, and what is the right withdrawal rate, what is the amount of money that you need. Be realistic about it. One is that the starting point should be how much money do you need, and make sure that money is not 6% or more, less than 6%, so that you don't end up consuming capital. There is the possibility that your need could be something, assuming that you have 5 lakh rupees and you want something like amount of money, and in 5 years time that money is consumed. That's all right, assuming that you need 1 lakh of rupees every year for a specific goal. So you take out 1 lakh rupees every year, and in 5 years time or 6 years time the money gets depleted, and you have chosen the withdrawal rate. So I think withdrawal rate is more important. So don't get attracted to a mutual fund for its dividend. Work on your plan, work on your withdrawal rate, work on your income requirement. That is more important. Many a times investors get attracted to new fund offers, the NFOs, simply because they think that the mutual funds or other mutual funds, older mutual funds, they have become their NAVs at a higher level. It is 100 rupees, 1000 rupees, and that is the function of age. And a new fund offer is getting started, it is at 10 rupees. So they have this false perception that it is available cheap. The NAV of a mutual fund doesn't matter, assuming that the performance of a mutual fund matters. Assuming that there is a new fund offer, which is available at 10 rupees, and there is the old fund whose NAV is 1000 rupees, and they are exactly the same. The portfolio is exactly the same, so they just gain 10% over the next 1 year. So your 10 rupee becomes 11 rupees, and 1000 rupee becomes 1100 rupees. And if you have invested 5000 rupees in both the fund, the performance will be the same. So this particular notion that new funds are cheap should not be a bait for you. Generally speaking, most investors should not invest in any NFO, simply because when choosing a fund, you should look at the history, not because the past performance can be achieved, but how the fund managed, how the fund navigate the tough period or the lean period or the rising period. And that is all that you get to know about a fund. And when a fund is starting, it is just a story. It is just a claim that, okay, they will be doing this. Mutual fund companies, they have to launch a fund. They launch a fund because that's the way of conducting, that's the way of getting started. Many people actually complain that why does value research or me, we keep saying that don't invest in an NFO. So how will mutual funds come into being? I think that is a mutual fund's problem, not your problem. Your problem is how to choose a good fund, and NFO does not facilitate that. NFO does not enable you to choose a fund based on facts, based on understanding, based on numbers, based on behavior, how it has conducted, so only after it gets little older, then you can get a sense. And that is something which we have factored in our methodology as well. When you look at the value research fund ratings, we assign a rating to a fund only after it has become 3-year-old, only after it has been in existence for 3 years. So that's one. There are situations where you can actually invest in a fund after it has been in existence for a while. Or there are situations, there are some funds, for example, the first NASDAQ fund when it was launched, I was very excited. Once in a while, very occasionally, there is a fund which is launched which is very tempting, which is very attractive, which is enabling access to a certain part of the market in a very interesting way. But generally speaking, those situations are very rare. Likewise, most fund companies, many new mutual fund companies are coming into being. They are coming into existence. They are launching their funds. So let them launch, let them establish, let them build their credentials. And I don't think you should think in terms of a missed opportunity. The way to look at performance of a fund when you should be considering taking your money out is quite different. Many a times people are just disenchanted, disappointed with negative returns. You invested a lakh of rupees and it has become 90,000 rupees and you are very upset and you're disappointed and you're willing to take your money out. That may not be a wise thing, because this may not be the worst performance. That may not be a bad performance. If the market overall has gone down by 25% and if your fund has gone down by only 10%, you might be in a great fund and it will help you withstand the market decline much better, or the fund is doing very well. But you have no reason to be happy. So that's okay. Be unhappy. That is the time when you should be asking question that, are you in the right kind of fund, or are you investing in the right manner? And because it's very important for any investor to be comfortable with the investment that they make. Otherwise, you will be getting in at the wrong time. You will be getting in in the wrong vehicle, and you will be getting out at the wrong time. And this is one of the biggest problem of investors. Managing yourself than managing your investments. Because if you invest in a fund simply because it is going up, just the next part of the story is that you should be getting out because it's going down. And that is how many investors are tempted to behave, and that is the wrong behavior. When you invest in equity, it will go up and it will go down, and over a longer period of time it generally goes up. And I can cite you can just look at the numbers yourself. Sensex started in 1978 was 100 points, and today it is at 60,000 points. And during this period, it would have gone down from its all-time high in its past, in its history, by at least 20 times. The market touched 4,000 points in 1992. And in another 6-7 years, it came down to 2,000 points again. Or the market went up to 20,000 points in 2007 end and came down to 8,500 on the Sensex. So market do come down. And if markets come down, and they don't come down, they crumble. They crumble after they have gone up very sharply. And that is the way of life. And if you actually get in while it is rising and get out after it has fallen, this is a guaranteed way of losing money, because you end up buying high and you end up selling low. So the way to deal with it is appropriate investment. Invest for the long run. Invest in equity for the long run. Invest regularly over the long run. And if you are a new investor, Don't invest in an all equity fund to begin with, because equity behaves in a manner which could be very unnerving for most investors. The kind of decline which I was referring to, 2007 to 2008 market going down by over 50% on Sensex. This is not going to, whatever we may say, it is very unnerving when you see that your 5 lakh rupee, 10 lakh rupee has now become 2 lakh 5,000 or whatever. Going down by 50% is not something very easy to withstand. The behavior is quite understandable, natural, and you want to really run for cover, and that will be a guaranteed way of losing money. So organize your thoughts, organize your method, and if you're a first time investor, start with a relatively more conservative vehicle. Only once you get used to it, and I think getting used to takes 2-3 years time. Once you have done that, then you can invest in an all equity fund. That's the most important benefit of SIP. Many times people think that it is some kind of trick or something, or it is a way to enhance your return. No, it helps you manage your behavior. When markets go down and you're still investing, you feel happy that you are able to buy things cheaper. If I'm going to do my SIP over the next 10, 15, 20 years, I would like the market to be very depressed for the next 5, 7, 10 years and go up only when I need the money. There are situations when you should sell your investments. You are investing for a goal, and that goal has been achieved. Early or little late is a matter of, it doesn't matter. You are investing gradually or regularly to buy your car or make the down payment for your house, and you are thinking that it will happen in 5 years time, and it has happened in 3.5 years time. Take your money out and achieve it. Sell your investments. You have achieved your goal. That is one reason. The other is, you did choose a good fund, and soon after you started investing, the fund started struggling. That is the time when you should be looking at things objectively. Just because the market is going down, you should not sell your investment. Give that investment some time, and that some time could be a period of 1 year to 3 years time. If it is managed by a new fund manager, I won't give him time more than 1 year. And if it is by a established, reputed fund manager who has done very well over the last 8, 10 years, 20 years, then I will give him 3 years time. But 1 to 3 years time, when the fund does consistently poorly, month after month, quarter after quarter, worse than the benchmark and worse than its peers, and that is a good enough time. 1 to 3 years, relatively poor performance than its benchmark and its peers, you should consider selling it. It's always a good time to be investing. Whether in mutual fund or not is a different story, but you should consider investing the moment you have earnings and you are able to save. Then you should consider investing. Make a plan, and if you don't make a plan, then get going with a recurring deposit or get going with a liquid fund, because if you wait for the right time, you will not get the right time, because market is always in a state of great anxiety. Either it is going up way too fast, and you'll be thinking that, okay, let it become a little reasonable, then you will invest. Or it is very scary, it is crumbling, and you will only keep waiting for it to come to a level where you will start investing. If you invest at that point, then it will go down further, and that is quite scary for any investor. So my suggestion is that get started anyway, or a better way will be make some plan and get started in an appropriate way. And either way, you should get going.
Well, with that, it's a wrap on this episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.